Hey guys, welcome back to the Multifamily Investor Playbook. I'm Mark Faris and I'm here with my co host, John Makarewicz. Super excited to bring you another episode of this playbook session. And the mission of the show is to be the ultimate guide for high net worth multifamily investors. And today we're going to be talking about how to select an emerging market that will outperform most of the other markets out there. The problem is you may not be living in one of these emerging markets today. I actually moved from a past emerging market that is no longer an emerging market. And John and I are here to talk a little bit about that background and then what to look for to be able to find these amazing markets.
Yeah, Mark, it's at the end of the day, real estate is hyper local, and knowledge of those markets and the markets and having that ability to kind of look at the data and look 5, 10 years ahead to make a really wise decision is critical to success.
Yeah, 100%. And, Barbara Cochran, her quote in real estate, the most important thing is location. She goes on to say that I've always said that the key to investing is the right location. And, Robert Kiyosaki says that the problem with real estate is that it's local
Yeah.
and you have to understand the local market. And so it's interesting that in general, it's really good to invest in your own backyard because you know it best, right? And a lot of cases that works out really well. So my background is I was originally from just north of Toronto, and that market had a boom. There was an emerging market, and it was just a really great place to invest. You could go in, you could buy a property that would cash flow from day one, meaning that you'd make more rent than all the expenses, including the mortgage payments. And then soon what happened was interest rates went up, but prices went up, which is the bigger factor. And just the properties just didn't make any more sense, right? So what do you do in a case like that, right? You're living in a market that maybe is currently it's overpriced and it just doesn't make sense to invest in that market. Every market is different, and that's what we're going to be going over here today.
Yeah, it's a really interesting example, when you look at, Canada, but specifically Ontario, there's some challenges happening worldwide where, the baby boomers were such a large population that the demographics coming behind it are just smaller. And so Canada, as you know, Mark, opened the borders and started allowing more immigration. But looking back 20 years, they sort of made a mistake. They were actually, the average immigrant coming in was in their late 30s. And so those people were coming in with money and buying houses. And, obviously you see what's happening. We have a huge supply crunch. And so we're seeing that in the US, we're seeing that in Canada. But it's sort of fascinating example. And then add to that just some of the political, forces in Canada, rent control and things like that. And you have a prime example. What was a great market now isn't. And what do? You're in that market. What are your options, right? And so looking outside that market is, the obvious next step.
At a high level, if you look at kind of the macros, overall in the economy right now, it's not super strong. So from a macro standpoint, you could be having, constraints on values and, where you're investing. But when we're talking about hyper local, you could have a city that is, we'll just say cash flows, and then a city in another state just right beside it could be, super expensive where the properties don't cash flow. And so some of these markets would be like, San Francisco, New York, where the value of the property is just, it's so high that when you go in and buy it, you're having to feed the deal each and every month because the rents that are coming in that market they push the limits, and the overall rental market won't pay higher than that. So you want to be able to invest in what we like to call the paths of progress, right? So where can you invest where the values are going to exceed what the overall average market is? And with these paths of progress there, we're going to be getting into some of the things to look for. And the other thing that's really interesting here, John, is that there's always an emerging market somewhere in North America. That was like very enlightening for me because I used to think that, across Canada and across the US, that, if the market was high, it was high everywhere. And if it was low, it was low everywhere. And, if it wasn't a good time to invest in, say, in Texas, maybe it would be a good place to invest somewhere north, right? And it's actually the opposite in general, because down south's generally a better place to invest. But there's always an emerging market somewhere, which means that you sometimes need to get up out of your local market and go hunt. And so we're going to talk about some of the things to look for.
Yeah, it's to your point, often we look at sort of the national headlines or, sort of whether you're reading, the Wall Street Journal or whatever, the Economist, and so you see, US is, economy's doing well and you think, great, we can invest in the US, but there may be a market that, industry is leaving. There may be a market that if you look ahead 3 to 5 years and see technology and certain things that are happening with tariffs, et cetera, and you might see some jobs moving, right? And so, we're going to dive deeper into this, but it's really something you have to spend a lot of time on doing a lot of research. And then once you find even a market, say for example, like an MSA, you really got to drill down into the submarkets because within a market, people are transitioning and moving, right? And so you see patterns of migration even within a city, including the suburbs, where one pocket could be incredible, but another could be, a loser, right? And so it's something we spend a lot of time on here at Faris Capital Partners, not just saying we like this area, but it's really like we like this subdivision, we like this sort of community within that larger metropolitan area.
For sure. And one thing that I've realized down, in a lot of these markets is that, crime could be strong one street over, right? And so if you go one street over, house values and overall investment is substantially higher, and you're going to get a different type of demographic coming in. So it's really interesting that what ends up happening is the locals don't know that it's an emerging market. And so what generally happens is when you have, we'll call it the passive progress. So for example, like we moved down to Naples, Florida, but Cape Coral, for example, is a market that in general hasn't had such a great reputation. And so, but Cape Coral is actually from a, we'll call it more of an Airbnb. I wouldn't so much say that it's a multifamily investment play that we would do today, just because it's more vacation and we like to buy around strong employment and strong jobs. But the example that I'm giving and why I'm giving that is because in general, when people are thinking that they're living in Naples, if they're thinking about Cape Coral in general, it hasn't been a very, we'll say, a location where people just love to go to. In general, it hasn't had such a great reputation. And so but that's generally the time where you start to really look at it, that's an up and coming market. And so the locals just don't know it. And so this is something that's really important why if you're working with a professional investment pro, is that we start looking at the things that are the underlying developments of these passive progress in these emerging markets. So the first main point that we'll talk about, John, and this goes for any business, but it's the same in a market, is it starts with strong leadership. Maybe you can talk about like leadership, John. I know you're really big on that, but in a market, you got to have the local politicians and the local leaders that actually want growth. So maybe you could talk a little bit about, how important it is that, it starts at the top always.
That's absolutely right. Yeah. So, in the US, we often talk in terms of red state versus blue state. So, blue state meaning, democratically leaning. They vote Democrat pretty consistently. You typically see that up in the Northeast, the West Coast. And then, states like North Carolina, kind of what you call the swing states, Pennsylvania, Minnesota, where, it kind of bounces back and forth. In fact, I mean, a handful of states effectively, decide the election. And so for us, we like red states for investment purposes because Republicans, the red state, leaders tend to be more business friendly. So you're less likely to see things like rent control. Generally, there's going to be less regulation and red tape for things like new development for investors. Programs that are developed are typically geared at the operator, at the investor sort of level, if you will, with the idea that if you make it easy for people to invest and to develop new buildings, then they'll create the supply that will lead. Now, what's interesting, kind of in this, where we sit right now at the end of 2024 is some of the blue states in the United States had ballot initiatives to make rent control a bigger priority. And so expanding it. So California, New Jersey were two examples. And what was fascinating is the voters largely rejected these initiatives. The facts are in rent control. While you may sit back and kind of on a pen and paper write it down and think, oh, that'll help. But the reality is it disincentivizes new development, which therefore creates bigger challenges. And you touched on this in Ontario, but skyrocketing property values, and therefore it's just not a good investment to buy rental property. Therefore, nobody does it. And so then you look at developers coming in and saying, well, gosh, if I'm going to be handcuffed on what I can charge for rent in the future, I just might not build in that market. And so, yeah, red states for us are the markets we like to invest in. And then you factor in, right, the bigger things. So beyond real estate, these red states tend to have better tax incentives for new businesses that come in. Where I live in Georgia is a great example. Rivian just got a $3 billion incentive from the Fed and the state to come in and build their assembly plant. So bringing thousands of jobs. And, it's new technology. So Rivian is such like kind of like almost like a viral kind of company. People like are excited about it, interested in it. So other companies want to come in behind them. Small businesses start to form around them. And so Florida is a great example of that. North and South Carolina is another great example of that, where businesses are actively moving there. And so that brings population growth, which brings, opportunities for investors. So, yeah, that's really our big focus. The other factor is just where's the sun shining? People now can work where they choose to. And I think people are deciding, I don't want to live in a cold climate. I want to live closer to the beach or closer to some good amenities. So the Sunbelt, as we sort of refer to it in that southeast, which is really this swath from like Arizona all the way over to like sort of North Carolina on the top end and then down to Florida. If you look at what's happening in the US, it's where the population's moving, it's where the jobs are going, and it's why we're such a big believer in those markets.
Well, definitely. I mean, in the health benefits, I mean, since COVID, more and more people are looking at health as a priority, right? And so that is another reason for the migration south for sure.
Yeah.
So going back to leadership, what John was mentioning there about these tax incentives, this is something that once the leaders agree that yes, growth is very good for us because that means more taxes coming in, it's a larger base there for them as well. And so once they say, yes, I want to grow, the tax incentives are just a genius thing because when they offer businesses tax incentives, there's more of a, we'll say, probability of them saying, yes, we're going to actually bring our new plant that's going to bring 5,000 new jobs. And with those jobs, it brings people in and that brings a higher tax base. So it's actually an investment that the city says, yes, we want growth. And it's like it starts the receiving process,
That's
right?
right.
And so these business friendly areas and cities are definitely a very strong starting point is when the leadership says, yes, we want to grow. And how can you find that out? You can just go to the chamber and just ask for, the official plan and just talk to the Chamber of Commerce or even the Economic Development Office within the city. You just go and call them up and they'll actually talk to you and they want to talk to you. They have people there that their jobs are to answer questions. So you have these businesses and they see these cities and you know what? The cities actually, they have people that go out and recruit businesses. Like the business development side of it, like they're going out and they're like whining and dining these businesses to try and bring them in. Like the best do that, right? And so it's a real hardcore thing that these cities are saying, yeah, we want to grow, and they take very intentional steps to make it happen. Now, the other thing that they do when these businesses are looking for areas to move to is affordability. Because, like for example, San Francisco, you need to make $200,000 to have the same lifestyle as somebody that's living in Charleston making $105,000, right? And so this is the affordability side of it, John, is something that again, we sold thousands of houses in the past until I started really diving in and saying, yes, from a professionalism standpoint, we got to go deep. And from all the analysis there, the affordability factor plays such a strong part. How important is that when you have, say, residents that are looking for new areas to move down to, and even businesses knowing that they could pay potentially half than another city if they were to move to. Like, how important is that when we're looking for markets?
Oh, it's hugely important. The headline right post pandemic has been inflation. It's been a big challenge worldwide. A lot of sort of flaws in our systems were exposed, from supply chain to wherever. And you're seeing now, particularly in the U.S., a lot of pressure politically to get more of the jobs and more of the supply chain back in the U.S. And that's Trump's kind of proposals for tariffs and some of those other things he's proposing. And if you factor in just the cost of groceries, right, the cost of housing, all these factors. In fact, housing is one of the largest drivers of inflation. So if you find yourself in San Francisco and it was already a very expensive market, the pandemic hits and now values have skyrocketed another 30 or 40%. Then you factor in the higher interest rates because inflation has driven interest rates up. It's this idea that somebody is now earning the same income but just doesn't have that buying power. And so what we like to look at, and gosh, here's a great example. When remote work kicked in, companies like Google started kind of going and saying, hey, look, like, we're gonna let you work remote, but if you're moving to like Montana, we might actually reduce your salary a little bit because your salary was actually partly driven by the fact that you lived near the office in San Francisco where it's very expensive.
Right.
If you're going to go live over there, that's great, but we're going to pay you a little bit differently. Right or wrong, that's how the company's thinking. And so companies are now thinking that way in terms of where they put their headquarters, right? So companies are relocating headquarters. We saw, say, for example, with Tesla moving from California down to Texas in that Austin market. And many other businesses did. And Austin has exploded with growth. Frankly, a little too much, right? And so they're having a lot of pressures on rent. So it goes back to, you got to look at where the population's heading, but then you got to go 7 or 8 layers deeper, because Austin's a great example. It's a great market. It's going to continue to be one, but if you're an investor in that market now, you're in a little bit of pain. So you can have too much. And so it's finding that right balance where the population's growing, but there's the supply that can help keep up with it. Because even for us, we go in and we buy 90s, 2000s apartments that we can come in and put the Faris touch on, through our management, our love and care for the residents, the aesthetics that we add to the space on the exterior, and then our interior renovation package. And that, attracts the tenants and can help increase rents. But, if you actually look, it's fascinating. Markets that have a healthy new supply coming online typically see the best rent growth because, there's supply, people can see that, they move in, and it kind of pulls everything else beside it. But you can go too far, and then all of a sudden you're oversupplied. So it is a very, I would say for us, before we even start considering a deal, we think about the market and the sub-market. We do a deep dive analysis, spend a few days just really looking at the location, and you got to drill into like a mile around the property. Then you maybe go 3, then you look at the city, then you look at the larger MSA, and then you have to kind of then go back in and make sure that all that data aligns. So it's a very, very thoughtful process on our side, and one that I think, gives us an edge.
In regards to the over deliveries, when it comes down to new construction coming on, we're going to be doing a separate talk as well on market cycles and how to be very mindful of not buying into an area when you see all the new deliveries coming on. That's a topic all in itself. So we'll definitely be talking more about that moving forward. And it comes to the affordability. Give you guys some context. 70% less in some of these areas for housing than some of these other expensive markets. Here's another one. $415,000 buys you in, say, Tampa. $415,000 buys a single family detached bungalow. So 1 story, 3 bedrooms, 2 baths for $450,000 in Tampa. Whereas in, say, Toronto or San Francisco, you're getting a 300 to 400 square foot condo, like a high-rise condo for that same price. So, just think of it. You're a potential resident, right? You are renting, and you have, $415,000. Where are you going to go? Right. And that applies as well for rent. Like, right. If you have, say, $1,700-$1,800 a month to pay for rent, you're going to get like this tiny condo, or you're going to get this nice detached bungalow that you can rent as well, right? And so this is what's going on in the minds of the tenants. So it's really important to put yourself there as an investor and say, okay, where are these people moving to? Here's another example: lower taxes. The tax rates down in, say, Florida, for example, they pay no state tax, no state tax. So the example here is I'm getting my hair cut, right?
Yeah.
And so I have a barber now looking after my hair now, Joe. But I had a hairdresser, and I think you call him hairdresser or barber or hairstylist, whatever.
I see a barber, but I hear you.
So her name is Barb, and she said, Mark, she moved down from Rhode Island. So we'll say more of an expensive market down to Florida here. And she said, Mark, if I would have moved down 10 years earlier, I would have been completely retired by now.
Yeah. Yeah.
She, and this example, and the big part of that is the incomes are really strong, but like the amount of expenses that you have, like when it comes down especially to taxes, when you're paying no state tax, that's significant savings that these renters are keeping in their pocket, which is very attractive. And you know what happens when you have a great experience somewhere, they tell all their friends and family to come down, which then it kind of compounds that growth even more. And that's definitely happened today.
Yeah, yeah. I mean, it's a reality, and depending on what state you live in, you might be paying anywhere above and beyond the federal tax rate, 6 to 12 additional percent. So 6 to 12% of your income goes away in most states, but states like Texas, Florida, as you mentioned, Tennessee have no state income tax. So, particularly for a renter, because property tax is part of the way they can make up for that. So for a resident renter, it's really an advantage. And, it just goes back to, those lower tax rates, those lower state income taxes or no state income tax in the example of Florida is going to drive an entrepreneur to be more likely to start a business in Florida because they know they won't be, hammered on taxes. So it's really a feedback loop, right? More business friendly, lower taxes, population grows, jobs come, et cetera. So, yeah, it's definitely key to really understand what's happening. And then, almost having that crystal ball to look ahead and say, what could happen in the next 5 to 10 years with the wind sort of change directions in terms of the political climate. And so for us goes back to those firmly red states where we feel very confident that we'll continue to have those types of incentives available for the people who live there.
Yeah, no, and the federal tax rate, it really depends how much income you're making. It's like in between that 10 to kind of high 30% is where it ends up, right? So it's a sliding scale, but when you don't have that state income tax, just a huge advantage. And just think of it, a dollar saved is a dollar, like it's even more than a dollar in your pocket because if you're making say $100,000 and you're paying 30,000 to tax, you're keeping 70% of that, right? So when you keep a dollar, it's actually more than the dollar in net in earnings, right? So every dollar you save when it comes to taxes is it like it's more than a dollar in your pocket because that's how much you get to keep. So it becomes taxes. I was told, John, by a business guy, the number one expense we all have is is taxes, right? So your goal is to help minimize that as much as possible, which, will be a whole other talk John and I will do on the tax advantages of real estate. Not only are you living in an area that is lower taxes, but when you start investing in real estate, you can actually use that to lower your income tax even further to a point where potentially you're making enough income where you can actually write down your income taxes down to zero in a lot of cases. And we'll have another talk on that and how that's done with with bonus depreciation and cost segregation as well. And we'll get into that moving forward.
Yeah, yeah, and the other side too. Look, I mean, it is part of the reality that a dollar saved, dollar saved, dollar earned. But a lot of people, so you're paying less in state income tax, but now maybe you have a little bit more money that you can buy consumer goods with and put back into the economy. So it kind of goes back to, it just helps continue to grow those business opportunities, which will then provide more employment opportunities, which then provide safety for investments in those markets. Yeah.
Yeah. So okay, so we have strong leadership and then we have affordability, right? So these are the big two. The next one is employment growth. So the above average job growth, this is something that we look for as well. Okay. So when it comes down to overall, we look at the national statistics and then when in the markets that we go into, we say, is that growing? Is the employment growing faster than the average market. Because if it is, that means that more people are moving in, which means that those people need roofs over their head, they need beds to sleep on, right? Which that essentially is a very strong market when it comes down to that. Now, the other thing we look for when it comes to employment is diversity. So maybe you could talk a little bit about, I mean, the example is Detroit, what happened there, right? It was all dependent on automotive. And, we saw what happened there. Real estate prices, as soon as automotive went overseas, it it tanked real estate prices, right? So maybe you could talk a little bit about the how important job diversity is when it comes down to employment.
Yeah, and I think to just, it seems pretty straightforward, right, when we say job diversity, but what we're looking for is a wide variety of employment opportunities within that particular submarket and market. So, Detroit is the perfect example. It's a boom bust market. It's had a few cycles, but, kind of got hammered in the 60s and 70s, again in the 80s, 90s, and the 2000, and, now we're at a place now where, most manufacturing is being done in red states or in Mexico or overseas. And so, for us, a great example is, you look for a market like, say, for example, Myrtle Beach in South Carolina. There are some pockets there that are great for investing, but the challenge of a market like Myrtle Beach is it is largely driven by tourism. And so we saw it with the pandemic. That is a sort of extreme example, but all of a sudden people weren't going on vacation. And so that market could take just a nosedive. And so what we look for is, like, Charleston's a good example. There is absolutely a tourism factor in Charleston, similar with Tampa, but they are robust economies on their own. So Charleston, I'll lean into a little bit. So South Carolina has a lot of military bases. So therefore, there is defense contractors and jobs that are related to serving the military or supplying the military. And, you look at the budget of the US. I mean, we spend more money on our military than, like, the next, like, I think 6 or 9 countries combined, close to $1 trillion. And that's never changed. That's considered, like, sort of untouchable in the budget. And so those jobs aren't going anywhere. Now, backing up a little bit, one thing you do have to be somewhat mindful of is if you are in a military town, if there's an active deployment, by law, rightfully so, we have to release those soldiers of their lease. And so you want to be a little cautious. Now, we like some of those markets, but it is also about what else is happening in that market. So if that did happen, are we protected? But, healthcare, banking, financial services, retail, then you add in restaurants and things like that. And so we were just looking at a deal in a submarket of Tampa. And what we loved about it is, it was very spread out. So you might see 10, 15% sort of in management services, professional services, 5, 10% legal, then banking, construction. And so when you look at it, it's a very healthy economy, because if one sector is to pull back, so right now, great example, we're not seeing a lot of new properties breaking ground. So we might see some construction jobs go away. And so if you're in a market where, 60% or 40% of the workforce is involved in construction, that's something you'd have to be hyper aware of before investing in that market. So just looking for a variety of, job opportunities. Once again, Charleston, a lot of tech companies are moving there. It's a really cool, robust, like, historic downtown. It's close to the beach. Young people want to live there. Therefore, young entrepreneurs are moving there and starting businesses. So it's really about looking for those markets that don't have one or two major industries dominating the workforce. It needs to be very diverse. So looking at, multiple industries with multiple styles of work.
Yeah, that's so well said, John. And anytime you can have we'll say a new facility that's bringing thousands of jobs, and it's like 15, 20 minutes away from the acquisition that we're looking at, that's a strong lure for us. Like, we love that when it's coming in. And of course, it can't just be like talked about. This has got to be like they're basically shoveling the ground is coming, right? And so this is something that 15, 20 minutes. So it's like, if you're a resident, how far would you drive to work? And so you got to get into the mindset of residents when it comes down to employment, and where they're going to move to, or where they're going to move to where they can actually drive to their work. And so the military was another good example that, well, actually, when we look at we're looking in a market, and we can actually look at the rent roll there and just make sure that we understand who the residents are in there, and then what's our exposure? I mean, we love to support the military. That's like super important. But if we look at the rent roll and there's like, 80% military, we got to factor that into our risk tolerance, right?
That's right. Yeah,
So
it's definitely something that you have to have a lot of focus and attention on.
yeah.
It's critical to the
For
success.
sure. All right. So next is population growth, and so this is seems like okay, that makes sense. Like, okay, population growth and everything kind of that we were just talking about. It kind of points to that, but there's some interesting reports and studies done, and U-Haul does a really great one on an annual basis. So they track the number of one-way trips that their trucks, so you can go and rent a truck, U-Haul truck, right? You see them driving around. When people are moved, they can go rent them, and you can actually do one-way trips, and they track that. And so the top cities for the last 3 years are Florida and the Carolinas. These states is where, and Texas is more of a third there, but Florida and Carolinas are two. If in And there's heat maps as well where you can actually go on through the Census Bureau and see where people are moving from and where are they moving to, right? And so John, like where are people moving from? Like maybe some of the states, and then where what are we seeing, and where are they moving to when we're seeing that heat map there?
Yeah. So what the patterns have been, and really accelerated post pandemic. California is losing more population than it's gaining. New York, New Jersey, high property taxes, high state taxes, high real estate costs. The Northeast, even you mentioned some of those markets like Rhode Island and Massachusetts, where great cities that have stood the test of time, no doubt about it. Boston, New York aren't going anywhere. People love to live there, but it is expensive. And you want to live in a 200, 300 square foot studio apartment where your bathroom's in your bedroom, or do you want to move down to Charleston where you can buy potentially a single family home or rent a beautiful new apartment for half the cost, right? That's maybe 1,800 square feet or 1,600 square feet. So, those northeastern cities. Now, you mentioned something earlier, but the health component, right? It's just the reality when you live in some of these cities. Unless you have the ability to afford the gym memberships or the Peloton or whatever, there's like a whole part of the year, 5, 6 months, where it's hard to get outside. And I think it's interesting too. A lot of people are really learning the importance of getting a little sunshine on your face every day. You don't want to sit out there for 6 hours, but that vitamin D. And so, it's the Sunbelt. I mean, we've said it before, right? But that's where people are moving, and they're typically leaving now. Interestingly enough, like the Midwest has actually been a market that's seen a shift in population growth, but it's largely been driven by robust economy and lower cost of living. So, states like Illinois have seen a little bit of an increase. Indiana, Ohio has a couple interesting markets. So, we like the Sun Belt. It's where we live, so we get it, we understand it. We're here every day. But typically it's coming from the West Coast and the Northeast and moving down south.
Yeah, that's great. So we have strong leadership, we have affordability, right? We have employment growth, population growth, and last but not least, from the main pillars, anyways, that we look at is it landlord friendly? And I'll share a story on how important this is. So we have still some portfolio up in Ontario, so just north of Toronto, and rent control basically means that you can only raise rents the set amount each and every year. Now, with some of the new construction, if it's built after 2018, there's still there isn't rent control on the newer inventory, but the challenge still there is they have very strict landlord tenant. We'll call it that the process of evicting a tenant. It could be 12 to 18 months if somebody is not paying. So it's very, we'll say the courts are very lenient towards the tenants. And so even if there's no rent control on the newer inventory, it still poses a major challenge from an investor, we'll say exposure, because, for example, if there's a non-paying tenant down in one of our assets in, say, Florida or the Carolinas, we can evict a non-paying tenant in 1 to 2 months. Whereas up in, say, Ontario, or we'll call it a more of a tenant-friendly location, it's 12 to 18 months. Like, think of the exposure if you're holding the property, and we'll take it like the reason why we like larger multifamily, we love 100 units plus, and we'll do another session on the benefits of that. But at a super high level, if you have one or two residents that move out or stop paying, you still have like 98 tenants paying still, residents, right? And so if you have a single family property, for example, and they stop paying, that's 100% of your income. That's no way to run a business. And if you know that it could take 12 to 18 months, if you find, especially if you find a professional tenant, you run into them and they start maybe doing damage, your returns can be wiped out very quickly. So for us in these rent control markets, we were experiencing some of that. And so for rent control today, it's 2.5% you can raise rents. And so we bought assets where they were $1,000 a month below market value. And so we've actually offered cash for keys. So, here's a lump sum to help you get set up in the next location. And we've offered two residents $30,000 each. And the one actually came back and said, I'm not taking a dollar less than $100,000 to transition out. And it's just, we'll just say, John, if we're going to be taking, any dollars and investing in it, I mean, it's one thing if it's your own dollar, but when you're taking other investors' dollars and, you're putting your name and your brand on it, you got to look at all the potential risk factors. And are you willing to risk, all that investment dollars that people work, their whole lives for, and put it into something with that kind of exposure? That was one of the big part why, we like these markets that we're investing in, because they're landlord friendly.
Yeah, and what's kind of interesting is even within, say, for example, like I'll use Georgia as an example, red state, landlord friendly, largely, but within Georgia, Atlanta, so Metro Atlanta tends to be a little bit more blue. And what's fascinating is if you look at what's happened is the courts are backed up now. The state law and even the laws within Atlanta do allow a landlord to move forward a little more quickly with eviction. So it's not some 18-month process. But the reality is that it created a scenario where it just got backed up. And what's happened is or I should say residents are starting to get familiar with this. I say residents, what I should really say is professional tenants. And so fraud exploded within Atlanta because people saw sort of a gap where, yeah, they're more landlord friendly, but the courts are backed up, so I can get in there. And so the laws actually were recently changed, so clear examples of fraud are expedited. But it's actually made Atlanta, and when I say Atlanta, I literally mean the city of Atlanta, not such a great market to invest in right now. So it goes back to, once again, this stuff is hyper local. So even within a state or an area that seems to be landlord friendly, you got to drill down and you got to look at the docket and like what's the backup. If somebody has a non-paying residence, how long is it taking to process? Even though I can file within 45 days or 30 days, it still might take 5 months. And so factoring those things in is important as well.
Another thing to really factor in as well is that if you're having a challenging tenant in our markets that we're investing in, when I say challenging tenant, I'm saying this disruptive to the other residents in the community. This is a major challenge for a lot of investors, right? You have maybe somebody is, smoking, and it's just getting everywhere. I've experienced that myself, and it's just hard to build a community or a culture within your residence, within your asset that you're investing into, because you have one resident or one tenant that is just not playing ball. They're not playing nice with the other tenants, or maybe they're screaming at some another resident, or maybe they're just like constantly late with rent, and they're not communicating effectively, right? So when it comes up for renewals down in these landlord friendly markets, so like for example Florida, the Carolinas, we have the option of not renewing their lease. And so this is not something like you have to use that. We're dealing with human beings and people's lives here, right? And so for us, it's a two-way street. Like we want to build, and we build great relationships. But if we have somebody there that on the renewal, they're just not fitting into the overall culture, like that, having that, we'll say that authority to be able to make that judgment call, it helps the overall culture within a community. Just like in a business, John, like what it's like when you have an employee that is just we'll say is toxic to everybody else. And everybody here that's listening, you probably experienced this. Like these are high net worth, you guys are high net worth investors that are listening to this, and you have seen this yourself likely, whether it's we'll just say it's it's a hockey team that your kid was playing for, and there's a kid on the team that is, just causing disruption for everyone else. Or, maybe it's a gym that you go to. There's just this guy there that's just causing disruption. Like, just think about where you live. If you have somebody there that's causing disruption, it'd be really great for the leader of the community, which is it's us, as ownership and our property management team that we work with, to be able to make that judgment call to say, okay, we want to elevate the overall living experience. This is what it's our main mission, to be able to elevate that and to be able to transition and get a new tenant in that fits within our culture.
Yeah, and to take it one step further, we can articulate, that culture in a sense within the lease itself. So that could be, sort of like dangerous dog breeds that are not allowed. In our communities, pets have to be approved, and so you might have a weight limit or certain breeds excluded. That smoking example is a prime one where we say no smoking. And so when the person is doing those things, we can actually, do a lease violation and file that. And so with a certain amount of lease violations, in some markets it could be one, right? But it just depends on the market. But even within the lease, if the person's actively violating that lease, we can move to evict them. So when you have that toxic person that's bringing down the overall culture within that community, it's like they say, right? One bad apple can ruin the bunch. And I've seen it in business, and we've seen it within our communities. One ill-meaning person can cause a lot of heartache and pain for everybody else around them. So we can process those people out of the community and bring somebody in that adds to the overall community. And I think our Largo deal is such a great example of that, where, we've been getting some reviews recently where, one that comes to mind, the guy's been there for 10 plus years. And he's like, I chose it because of the location. I like the unit, but now it feels like home, and just the service we provide and things like that. But part of the first thing we did is we looked through the rent roll and we looked at all the lease violations, and we made some decisions on who we wanted within the community and who we didn't. And that might sound harsh, but the reality is, people work hard. They're laying down, sometimes 25 to 35% of their income for this home where they live and raise their family or retired or whatever the situation might be. And so it's not fair to them to allow somebody to come in and ruin that experience just because, they're a jerk or whatever. So we're going to process them out of the community and bring somebody in that's a better fit.
So well said. And so final thought when it comes down to, am I in an emerging market or not? One thing that I really, if we were to boil everything down, I really look at, do deals in this market cash flow, right? Does the income that's coming in, is that greater than all the expenses? And so people ask me, Mark, when you invest in real estate, what do you like? Do you like appreciation or do you like cash flow? Robert Kiyosaki says, always invest for cash flow. And so over the last few years, it's really been clear to me, I've seen it firsthand, the importance of buying properties that cash flow. But my answer to the people that ask me which one, is it appreciation or cash flow, is I want both. I want both in a big way. I want properties that cash flow and I want appreciation. And I thought in the past that, you in some of these markets, it's only about appreciation because just the deals don't cash flow. But the reality is, you can have your, what do they say, John? The saying, you can have your cake and eat it too.
Yeah, that's right.
Thing.
They typically say you can't have your cake and eat it too, but you can.
You can't have your cake and eat it. Yeah. I'll make sure to get that right on the next one. But so there you go, guys. I mean, that gives you, as just to kind of wrap everything up, strong leadership, affordability, employment growth that has diversification, population growth, and landlord-friendly rules. These are the areas that you want to invest in. And of course, that the property's cash flow. Just like if you're buying any business, which that, by the way, is how we look at these assets. We look at them as we're buying businesses. And so with John and I, with our background, we look at this and say, hey, listen, is this a business that we want to buy? And it's got to be productive as of day one. It can't be, we're going to go in and spend all this money first because there's higher risk tolerance. It's got to, from day one, it's cash flowing, it's making money, and there's a clear pathway that we've proven out in the past that can get X amount more in net operating income, which then increases the value of the overall building. So, John, this was just a great We went a little longer than expected here, but I think this gives any potential multifamily investors a very good foundation to start building on, and when you're analyzing a market, to things to look for.
Absolutely. Yeah. And just to kind of sum it up on my point, that last piece there, when we say cash flow, we're really saying profitability, right? And that example, we're buying a business here and it's not 100%, but the cash flow is really that first domino in the sense that, strong cash flow, strong profitability will generally lead to the appreciation. So there are some markets where all you can bet on is appreciation. Maybe Ontario, Toronto is a great example of that. And, you'll probably be proven right, but having that cash flow is that first domino that leads to that profitability.
Well, yeah, and if you don't get it right, and we're seeing that in some of these markets right now, like especially in the condo market, say in Toronto, for example, people that were just expecting appreciation, they're getting smoked
Yeah.
in a
Yeah.
big way. And so this is where, when you're investing, Warren Buffett says rule number one, don't lose money. Rule number two, don't forget rule number one. Right.
Right. Yeah.
And, that's where you find, like, as you start getting more and more wealthy, you start to think more and more wealth preservation.
Mm.
And so this is such an important part to buying properties. That cash flow is like, it's like 101 for us right now, that we're hardcore on that. And, our investors really appreciate that about us, that, in any sort of market downturn or cycle, that these assets are extremely resilient because, we have strong, we'll call them golden rules that we follow when we invest in real estate.
Yeah, that's right. Well, no, it was a great talk, Mark, and thinking about markets is something we love to do. So at Faris Capital Partners, it's that first thing we really focus on before we even look at an asset.
Yeah, for sure. So next episode, we're going to guide you guys on market cycles. And so not only market cycles and the four different sections that a cycle travels through, but where we're at today, where multifamily is today, and moving forward there, what you can expect coming down the pipe. So look forward to that in our next episode. Thanks for listening. If you enjoyed the show, please subscribe and share it with other high net worth investors that you think will benefit from it. Thanks again for tuning in to the Multifamily Investor Playbook. We love and believe in you guys, and keep on dreaming big.